It's been a pretty busy day and it's some pretty wild moves at the stock level particularly. So let's go and get a man who's always keeping a close eye on what's going on and knows what's happening in the go. Martin Crabb from Shaw & Partners joins us live here in the studios. Martin, good to see you.
Good to see you too.
Well,
what could have been? It looked like such a great start to the day. Of course, what we saw yesterday, and then just fell in a heap towards the close.
It looked like everybody was getting a prize, which is the new normal, right?
Well, after a big move yesterday, we looked like we were going to follow it up today with another 1.5% move, but we've closed flat, which is a little bit disappointing. And you can't just blame the RBA statement. I think the market, as you showed, it peaked on the open really and just drifted all day. So there's obviously a bit of nervousness out there about this long end of the yield curve story. We're through reporting season. It has been on our numbers the best reporting season in 20 years because analysts have actually upgraded forward earnings by about 4% during February. So that's the highest going back 20 years. It's the second best in the US. The only one that was better in the US was in 2018 where we had those tax cuts coming through. So people were upgrading on the back of tax cuts. So it has been a ripper of a reporting season, but the market's just got so driven by macro at the moment. Almost what's happening at the stock level is of secondary importance, but certainly lots of winners and losers out there.
Well, in terms of sticking with macro then, so one of your top is a bank. Which bank do you prefer and why?
Yeah, I think Westpac's moved to the front of the queue. We for a long time, and this is pretty much a 2020 story, just favoured CBA because when you don't know what's going to happen, you buy the quality franchise. And what the quantitative numbers showed last month and even for most of this year that people have been fading quality. They say, actually, we want to buy the stock that's got the most leverage to the recovery. So that started not to be CBA anymore because it's at the other end of the spectrum. It's got less leverage into the economy. So you go with ANZ, it's probably the most high beta because of its institutional and trading business. And now that's performed so well, it's now looking like Westpac. So during reporting season, I think Westpac, even though it was only a trading update, was one of the standouts because it really did surprise the market with how profitable it actually is. Their net interest margins are up. Their bad and doubtful debts actually wrote back $500 million. You don't often see banks writing back provisions, but that was $500 million. So they came in with a $2 billion quarterly profit, which is pretty amazing. So that's obviously the standout. So that's now moved to the top of the pecking order.
We had the Golden Globes overnight, so we might as well go stick with the awards ceremony here. So Westpac gets best on ground for the financials. Treasury Wine Estates. Yeah. It's been a pretty rough ride for shareholders there, but you liked what you saw.
Again, you talk about bottom up and top down. Obviously, what's happening with China and their ban on premium Australian wine, that's knocked Treasury Wine for absolute six. The fact that the CEO, who everyone loved, Michael Clark, stood down to spend more time with his family, which no one ever believes when people say that, right? He left early, so they had new management. They talked about spinning off Penfolds. There's all this sort of noise going on, but their actual profit result was actually much better than the market thought. The biggest issue for these guys is can they redirect the premium wine from China, which is the big growth market for them, to other markets without discounting it. So if they can shift the Grange and the 389 and all that stuff to markets, and they were very confident that they can. They said it's a prestige market. These are very well-considered wines, and we can move them without getting the margin upset. That was very good news. And also, they look like they're closer to divesting their US commercial wine operation, which has been a bit of a dog. So the market gave them a big tick. I think they were up 15% last month on the back of that. So
coping without China.
Yeah, yes. I'll put my hand up for the Grange if they're on.
Yeah, I was going to say we deflected our way here. Okay, so who gets the Razzies?
Yeah, the Razzies were two A stocks, so A2 Milk and Appen. Interesting, A2 Milk was one of the best performers today. So it got absolutely belted. They came out and guided EBITDA and margins lower than what the market had anticipated. So obviously there's a couple of things here. One is the Daigou market, so that's people who are travelling to Australia, hoovering up all the infant milk formula they could find, stripping the supermarket shelves and then sending it back to China. And then there's also, it's interesting thinking through what a lockdown does to people's behaviour. So things like dry cleaners are going out of business because people aren't getting dressed up to go to work. But the other interesting one is mums staying at home, breastfeeding and not using as much A2 milk formula. So that infant milk formula market is recovering a lot slower. So the management talked to those two things. Again, the market's up here. The company came in guided down here, lofty PE stock. That got smashed. Similar story with Appen. So these guys annotate data for AI algorithms to run. So a very simple thing is something like a self-driving car, it needs to know the difference between a person and a lamppost, for example. Or a zebra and a zebra crossing is the other one. People have been worried about competition in this space, and also companies getting big enough to do this stuff themselves. They have a crowd of about 1 million people that do this data annotation. So if it starts to get too expensive, companies can insource it. So the biggest issue with them is, again, their guidance was for 10 to 20% growth in EBITDA, but it was on constant currency using 69 cents. We know the currency's closer to 79, so that's a big headwind for the company. So that was another one that did surprise to the downside, and that got belted as well. So the two winners are Treasury Wine and Westpac, and the two losers are Appen and A2 Milk.
All right, let's get to the charts, because we love a chart here, Nat and myself especially. Now, you've got one here where, trying to put in context, where people are starting to fret about what's been going on with the bond curve, yields are rising at the back end, but you've got a chart that kind of dismisses that the threat at this stage is not really that material, because earnings are rising faster than yields for the time being.
Yeah, so the again getting back to that point we made at the start, is that the macro is driving the market, but what is happening in the bond market, and this is according to the Fed, is very healthy. We are seeing interest rates sell off at the long end, and that's because the market's more confident that the economy is growing and that there's going to be inflation at some point in the future. So rather than panicking about it, the central banks are going, we kind of expect this. The flip side for investors is higher bond yields mean lower PEs, mean lower share prices. Now, what happened back in 2013 is we had bond yields go up without earnings going up, so the market got smashed. What's happening now is bond yields are going up, but earnings are going up almost as fast. So, as I said earlier, the ASX 100 stocks got upgraded by over 4% in February, and here's February back to year 2000. So you can see that that's a very, very strong number, and as I said, it's the second strongest in the US. So even though the PEs are coming down on these higher bond yields, earnings are ripping, and we've continued to see earnings upgrades. Even today, we saw a raft of upgrades on stocks because they had reported better than expected results.
So with all the taps globally, fiscal policies flat out, monetary policies flat out, wouldn't you be disappointed if earnings didn't pick up? You would
hope so, right?
You'd hope so.
And to the Reserve Bank's point, they want to see wages growth. Well, we need profits to grow first. Management teams are generally not charitable about giving out shareholders' funds to people. So if we're getting a rise in profitability, that's a precursor to a rise in wages. So we can't really get the second part of what the RBA want without having materially higher corporate profits.
Well, as you know, we've just been through reporting season, and we've spent most of the time talking about, did you need JobKeeper?
Yeah.
So we might be a year away from, are you hiring people and are you paying higher wages?
Yeah.
I think that's a long way down the track.
Yeah, we've got to get through that whole hump where people come off JobKeeper or JobKeeper 2 or 3 or whatever they're going to call the next version of it and actually have a proper job. But, there are obviously people who got a pay rise during JobKeeper. So the wages data is probably artificially elevated at the moment. So what the real wages outcome in Australia is probably quite weak, which is why the RBA is going foot flat to the pedal for at least 3 years, right?
Yeah.
Let's finish off in that space. You saw the RBA statement like everyone else out there today. Anything that really stuck out to you?
No, it's super dovish, as you said. They're throwing the kitchen sink at it. They've said they've got couple $100 billion to throw at the bond market. The issue for us is really, what does it mean for the dollar? I mean, being super dovish, the dollar should be coming down. But the problem is the US is even more dovish. They're about to throw $2 trillion at their economy. So we're kind of pushing on a piece of string right at the moment. So I wouldn't be surprised if, even though that's super dovish, the currency continues to rise.
Yeah, don't fight the Fed on this
Fed.
one. I mean, the RBA is in an enviable position in that it's sitting on one of the best countries in the world.
Yeah.
But it does come with responsibilities.
It also sounds like a good measure and good pitch to go and look at currency hedging, of course, as well. If you're concerned about what's going on with the FX markets, so that's always an option. Martin Crabb, Sharon Partners, always fantastic to have a chat on a Tuesday afternoon. Good to see you again, and we'll speak soon.